You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now in studio, Mandeep Singh, senior technology industry analyst over at Bloomberg Intelligence. So this was a headline that Lisa talked to us about earlier in the morning, and we were both like, nuh-uh, that's not for us. So apparently Uber strikes an accord with GM Cruise in terms of Uber's going to have self-driving cars roaming around. Do I want this in my life?
Well, I think it's just a function of how technology gets rolled out. So
that's a yes from Mandeep, isn't it? He wants yes. Okay.
He's a forward-looking guy.
We see that already in 3 cities in the U.S., San Francisco, Phoenix, and L.A. And what Waymo has shown is they have the technology to have the car ride on its own. And even though the scale is very small, they're doing 100K rides per week. Compare that to Uber, which does 10 billion rides in a year globally.
Whoa, what kind of rides are we talking about? Oh, just 10 billion, just regular
10
rides.
billion regular rides.
Okay, got it.
So Waymo, compared to that, is doing 100K rides, so 5 million annually if you run rate that. But look, what they have shown is this is the future. And Uber is trying to figure out where they fit in this future because they don't have their own autonomous technology, so they have to partner with someone. It's not going to be Tesla. Tesla has told us they want to do ride sharing via their own app. They don't want a ride sharing intermediary. They have the fleet, they have the software, they have the app. Why use somebody else's app? And in the case of Waymo, even though they have a partnership with Uber, bulk of their rides are through their own app. So that's where Uber doesn't have a choice. It partners with Cruise. Cruise is, in terms of the technology, I would say way behind Tesla and Waymo. But at the same time with Uber, like I said, they divested their own autonomous R&D division back during the pandemic. So they're not developing anything in-house. And in this case, it's just a matter of getting what they have in the market.
My first reaction is like a hard no. I'm not getting to an autonomous vehicle. But I get into a vehicle every morning at 4:30 in the morning with some dude I don't know.
Yeah, we're just not the early adopters. I think is more to the point.
Adopters. Yeah. All right. But what's better than the other? I don't know. So how does Uber view, the driverless technology? Is it long-term net positive or?
It's definitely a negative simply because Uber operates on an asset-light model. And even then, it struggled to reach profitability.
Right.
Now it's at a point where the incremental margin is positive. What happens with autonomous rides is the incremental margin goes much lower because one, you have to license the technology from somebody, in this case Cruise or Waymo, so you have to pay them. And then the take rates go down because the autonomous rides have a much different unit economics than a ride with a driver. So instead of getting that 30% take rate, their take rate goes lower.
But eventually, I guess that's not true. I was going to say eventually the money that they'd have to pay to, say, GM Cruise, does that decrease? But no, it probably increases, right? Because GM's going to want to get more for their
Exactly.
stuff.
So if you don't own the technology, why would a GM or a Waymo or a Tesla want one more intermediary when they could do their own app with the fleet? So Uber has 2 choices. Either they license the technology or they start buying the cars. And if they start buying the cars, it's not an asset-light model anymore. So they have to buy the cars from Tesla, buy the cars from Waymo, and these are very expensive. Yeah.
Why then did they divest their R&D back in the pandemic? It seems like now I understand that long-term, that's a problem.
Yeah, it is. And back then, they were under pressure. Remember, when we went into the pandemic, all these companies had cash flow issues. They were burning cash every month. So the best option for them was to divest this, raise cash. And, it was never part of their long-term plans when it comes to developing this in-house. And I think right now it's proving to be a wrong decision.
So how then does Uber, if you're an investor and you're looking at Uber stock, how does that have to be re-rated then? Longer term, like short term, forget it.
So look at what we have now. Uber is still the scale player. I mentioned 10 billion rides.
Right.
And right now, they are the ones who have the most supply. Now, if this thing scales up very quickly, which I don't think anyone is betting on right now, that autonomous skills. There's a lot of skepticism around taking these rides. So this will be more gradual.
Front and center right here in front of you. Yeah.
So in that case, I think Uber has more time on hand. Like nobody is thinking of a next 12-month scenario where Uber loses, 30% of their volume. We're talking about a gradual shift towards autonomous. And in that case, Uber has more time to do these kind of partnerships. I think Cruise is one. They'll probably try to partner with Tesla, if that would be my guess. Even if it comes at the expense of gross margin, they'll take the hit because it's all about existence and, maintaining the platform. And
all right, Mandeep, we appreciate it. You here next week?
I am.
Oh, yeah. NVIDIA. See, I'm telling you. NVIDIA has changed everyone's vacation schedules.
Yeah, it's a good point.
Mandeep Singh joining us, a senior technology analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, today's Focus on Munis is brought to you by BAM Mutual.
BAM.
BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Be part of building America. Invest in BAM insured bonds. Our next guest joins us, Amanda Albright, municipal finance reporter for Bloomberg News, also formerly of the Daily Tar Heel, which means she went to the University of North Carolina, which means somehow she got through my screen of no Tar Heels on this program. But she's pretty solid there.
Watch out.
Man, to talk to us about the municipal bond market, you guys have a lot of great stories out recently. The one that really grabbed my attention is colleges need up to $1 trillion of campus upgrades to lure students. And I guess they're coming to the municipal bond market for that?
Yes. So Moody's put out this estimate that colleges and universities might need 750 to 950 billion of spending on infrastructure, facilities, dorms, classrooms over the next decade in order to essentially stay competitive. The interesting thing about that number is that only encompasses their universe of credits that they rate. So the actual number could be even higher. It was interesting. This story came out. Basically, the argument that Moody's is laying out is that colleges need to have really pretty campuses in order to attract customers, their students, and their students' parents who want their kids to go to a really pretty looking school and have kind of that pride. But interestingly enough, after this story came out, I got some messages from readers that disagreed with this premise and think that schools need to focus on teaching students and providing a good academic experience, and they don't need to think about facilities. So it's an interesting topic within higher ed, and that kind of balancing act that colleges are facing right now, trying to invest in facilities, trying to lure students, but also keep costs low and focus on their core mission. It's kind of one of those core debates in the higher ed world at the moment.
Well, also, isn't it true that like the tuition, even though tuition's insane, and we're talking like $80,000, like that doesn't cover at all necessarily one person's entire education there too?
That's true. I think the interesting thing that I think colleges will need to grapple with, and something I'm interested in, is how much they kind of break down those costs for future students. How much of tuition dollars are going to facilities? I think that's an interesting question.
All right, more money going to universities, less money going to municipal funded detention centers on fewer inmates. What's going on there? Yeah.
This is a classic political situation in the muni market. We've seen with changes in political control, different approaches to detentions and corrections policies. And so I think really that story, which was a great story that came out, I think yesterday, it highlights this growing risk that muni investor, you talk to any muni investor right now, and politics are at the forefront of everything, especially the presidential election. The corporate tax rate could be in play. Individual tax rates could be in play. All of that will kind of affect munis. And then you have all these other, lower impacts as well, such as corrections projects. Like all of that is very affected by politics. So that's why muni investors are very focused on the election these days, along with everyone else.
All right, Amanda. Yeah, everybody else. All right, Amanda, thanks a lot. Amanda Albright, Bloomberg Muni Finance Reporter, joining us from Kansas.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Looking at the screen, lots of things moving all over the place. Stocks up, yields down. I'm looking at gold up 1.25%, oil up 1.9% on WTI crude oil. Is there a correlation there? I think our next guest has some thoughts on that. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence, zooming in from Miami, Florida. Mike, what's going on with gold and crude?
Paul, hello. We have the difference between an enduring bull market, that's gold. Right now it's at, if you end the month now, it's at a record high, and an enduring bear market, that's crude oil. The price on the screen you see right now, WTI, $74 a barrel, about there, was first traded in 2006. That's almost 20 years ago. And as we tilt towards this easing cycle, typically that spread with gold outperforming crude oil widens, and it looks like it's just getting started.
First of all, you buried the lead. We're not coming to Miami, Mike, so you can stop looking for fun things for us to do. You can not worry about your guest rooms. Like, we're good. So the record high, though, that we saw back in gold that we keep hitting here, I'm really struggling as to what is actually leading it, because the last 10 years when we had low rates and all that, gold did a whole lot of nothing. And it has just been feeling like a nonstop tear in the last few years.
Yeah, let's start with two things. The unstoppable rise in U.S. debt to GDP, the very expensive U.S. stock market, the Federal Reserve tilting towards easing, and the most significant elephant in the room is the unlimited friendship between President Xi and President Putin. That shifted the world order in favor of gold, and it looks like it's accelerating. So the deepest pockets on the planet, i.e. starting with China, have been buying the metal. And it looks like once we get a little bit of reversion in lower yields, i.e. T-bills not at 5% anymore, and maybe just a little back and fill in the stock market, gold will shine. It looks like it's continuing to do that. Now, right now, it's a little bit overdone. Managed money net positions, i.e. futures, are really long for a reason. It's a bull market. But the narrative for gold is quite strong. And I'll just end with this. Gold is historically very cheap versus S&P 500. If you just take it divided by the ounces divided by the index, particularly when you enter recessions. What oftentimes happens when you enter recession, the Fed eases, that spread just kind of narrows a little bit.
What would change this? It seems to be a structural bullish call on gold, Mike. What would need to change that?
I think the first thing is the U.S. stock market to stay resilient. Well, why buy gold when it's that resilient? The most significant thing was some kind of unexpected détente, i.e. President Xi picking up the phone saying, yeah, we're done with this unlimited friendship. The détente that's happening globally is part of what's really driving gold, i.e. somewhat getting away from the dollar, looking for an alternative to U.S. treasuries, particularly with yields dropping and the debt to GDP just continuing to rise. So that, to me, would be one of the most significant things. Otherwise, it looks to me, once we get a little of reversion lower in the stock market, which at some point will happen, gold will probably shine like long bonds. Like on the month now, on the quarter now, gold's up about 8%. And the U.S. Treasury, the Bloomberg 20-plus long bond index is up about the same, about 8%.
What about positioning at this point? Like, I know the central banks are buyers, et cetera, and that and price spikes, you're not going to see a lot of physical buying also, et cetera. But who's left to buy in the futures market?
That's a key thing, Alex. A good point. About 44% of total COMEX futures positions are speculative longs. That's very high. The high really gets much higher than 48. But what's really happening is we've had significant outflows in gold ETFs since that peak in 2020. They're just starting to turn to inflows. And I think that is part of that alternative you see with people going to cash and bonds. They're looking for alternatives to the expensive stock market. So that looks like it's just rolling over. But if you got a day like we had on August 5th when markets go down, you hit you sell what you can. And there's a lot of speculative longs in gold at the moment for a good reason, though. It's a bull market.
That's a trader's term. You sell what you can.
Yeah.
Yep, on those days. Hey, Mike, thanks so much for joining us. Appreciate it very much. As always, Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. I'm looking at like some of the, whenever I talk to Mike, I put up GLCO, the Global Commodity Price Screen.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So let's get to the markets here. Equities rally, you have a bid into the bond market, and the dollar's lower. It's classic. The Fed is going to cut. I guess the question is by how much? And then how does that affect your positioning? And the why they're cutting, too, very much important. Dana Dioria, Co-Chief Investment Officer of Evestnet, joins us now. Dana, how did you view the Jackson Hole speech by Powell? Was that 25 cuts for you in September, or was that 50?
I think it's 25. Look, I think you could not ask for more dovish comments from Powell this week. I think he knew that the market needed to hear something like that in order not to react negatively. We've obviously been pricing in significant decreases. And so he delivered, right? And he gave us a speech that said, yep, I'm there. I think, and even words like ensuring that inflation is anchored, it was not only a dovish speech, it was sort of a victory lap, right? For him to say, hey, our monetary policy worked out, we've tamed inflation, now it's time to turn to unemployment, and we are going to cut. But I don't think that means, all that excitement means that we're necessarily getting 50. I think it's his way of saying, yes, we can all breathe a sigh of relief. I think he still gives himself the 25 in September.
Hey, Dana, just looking at the price action today, the Russell is up 3.3% versus a 1% for the S&P 500. So I guess that rotation trade into maybe smaller mid-cap stocks out of, some of the other big-cap names, maybe that's really a thing. How do you guys think about that?
Yeah, look, obviously small caps more interest rate sensitive, and this is great news. And certainly as you go into an interest rate reducing cycle, you're looking at benefits to small caps. You're looking at benefits, obviously, in the real estate sector, already somewhat expecting that and pricing that in. So not surprising to see that. And then you mentioned even in your intro, but what is the reason we expect the cuts? I think if you think that cuts are happening because, the Fed is a little bit worried about what's going on in the economy, that's not good news for small caps, right? It's short-term good news, but it's not good news, if you think you're looking at recession. If you think that the Fed is playing this right, they're hitting the ball right down the middle, they've tamed inflation, and now they're going to prevent problems in the economy, great news for small caps.
I guess the question, though, becomes, do they wind up cutting because there is a recession? And that's kind of the unknowable, because if they're cutting for that elusive soft landing or normalization, shouldn't that be a different distribution of investment than if you are cutting because things are bad?
Yes. It would be. Look, high level, we advocate strategic, long-term, diversified thinking. Don't try to time this. That said, if you're thinking about tilting in a certain direction based on one of those outcomes or the other, if you think recession's coming, you're tilting towards quality, right? You're tilting towards low volatility stocks that sort of act as a ballast in bad weather. If you think that the Fed is getting this right, that they are cutting in time, that they're not late with this, that they're pivoting at exactly the right moment, that we are going to avert, a problem with this. The AI trade, maybe your thesis is the AI trade is, full steam ahead, and we're even going to start to see productivity increases in the rest of the economy. Then, areas like small and value where they've been kind of ignored from a valuation perspective, they look a lot more attractive. You're going to be leaning more heavily there.
All right, Dana, so today's price action shows us that obviously the Fed still matters. The market cares what the Fed's going to do, but so do earnings. And we just kind of finished up an earnings cycle here. Any takeaways for you that maybe influence the way you're thinking about opportunities?
Yeah, look, earnings are cooperating, right? Earnings are in the plus category here. We've had a nice earnings season. Combined S&P 500 earnings grew nearly 11% year over year at this point. We do have NVIDIA still to see, obviously, the AI king. We want to see where that's going to go. That's going to be meaningful for the market, potentially even on the same level as today, right? To the extent that AI has been driving a lot of the market's valuation increases, the multiples that we're seeing in a big, that big tech-heavy concentrated part of the market, communications and tech. So that's going to be very important. But certainly what's nice to see about, earnings right now is that with nearly 80% of the companies beating their expectations and most of the sectors doing well, sectors like financials, this is good. It shows breadth, right? It's not just earnings coming from that concentrated part of the market that's highly valued.
So I'm glad you brought that up, because I feel like I've been asking this question ad nauseum, which is NVIDIA going to be a market event, or is it going to be a Mag 7/chip stock event? Where do you fall on that?
I think it's going to matter,
Okay.
Because of course we already do have the news now from Powell. And obviously, notwithstanding, we've got a month before these cuts actually take place, and that's a lot of time for data to shift one way or the other. But it's pretty well baked in that, we get the 25 in September. So the market's pricing that in. And now the question does become, where goes NVIDIA has gone, to a certain extent, belief in the AI trade. Of course, we know that there's a whole, satellite system of companies around there that are AI driven and, carry the flag for AI. But let's face it, NVIDIA is the market sort of bellwether for that. And I think that does matter a lot. Because again, a lot of the valuation increases we see on the large cap side in that growth space are around this thesis.
Dana, on the fixed income side, where do you see opportunity?
Of course, obviously, the expectation now with the Fed decreasing rates, and you start to see some movement there. I am and remain, a candidate for just diversity across the yield curve. I don't think it's smart for the average person to be betting on interest rate cuts. I think, the market is pricing in the interest rate cuts as quickly as they're pricing in, equity changes. So if you're in the retail advisor area where we exist, tilting one way or the other on interest rates is a tough thing to do. It's not just the Fed. When you think of something like the 10-year rate, which obviously we're all watching now, there's a lot that goes into that rate. It's not just the Fed. It's the market's expectations about where the economy is going. How much growth are we going to see in the midterm? So I say, make sure you're diversified across the yield curve. I don't even think a barbell. I think, trying to get across the yield curve is the right place to be.
All right, Dana, we really appreciate it. Thanks for jumping on this Friday. And next week, definitely going to be a busy week as well. Dana Dioria, a co-chief investment officer at Evestnet.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.